14 of 21 series are aligned with stagflation mild this morning. That is a moderately strong degree of systematic agreement across the framework's 21 series. The current macro regime is stagflation mild, with a confirmation score of 14 out of 21. In regime terms, the engine is observing a macro regime where growth momentum is mathematically decelerating at -0.5777, while inflation momentum is gently accelerating at +0.0081, a combination that reflects softer activity data alongside a mild build in price pressures. Coherence score. Moderate and confirmation score 14 of 21 tell us that a majority, but not all, of the 21 series are lining up with this stagflation-light configuration. By our historical sampling, regimes with this level of confirmation have persisted in roughly 41% of comparable 3-month windows, an observation of past behavior only. Compared to last week's reading, the confirmation score is unchanged at 14, which means the degree of alignment across the 21 series has held rather than breaking higher or lower. Historically, environments like this have felt choppy across markets. Equities have shown sector-differentiated moves, and bonds have alternated between relief rallies and renewed rate pressure, a record of how prices behaved under similar mathematical pressure, not a roadmap. On the yield side, the 10-year Treasury note is sitting below the 4.45% trigger the framework tracks, with the MOVE index of rate volatility at 65.4 and near the bottom decile of its 2-year range, a normal, low volatility read. That green momentum label for volatility means the index is subdued and drifting slightly lower in rate of change terms. Market participants watch this because it speaks directly to how aggressively rates have been repriced. In our framework's reading of comparable periods, this roughly coincided with steadier bond markets and more measured equity rotations within 1 to 2 months. An observation under our methodology, not a forecast. The question it raises is whether such calm in rates changes how much duration or credit risk institutional investors are comfortable carrying. What would challenge this interpretation would be a sharp, sustained jump in yields and the MOVE index toward their higher historical percentiles. Labor is represented in the framework by non-farm payrolls and related employment indicators, which the engine currently flags with red momentum, defined as slowing job gains and softening breadth in hiring, once adjusted for trend. Investors watch labor data because it anchors views on household income, consumption resilience, and the potential for earnings pressure. In our framework's reading of comparable periods, this roughly coincided with a more uneven path for cyclical sectors and consumer-linked assets within subsequent quarters. A record of past behavior, not a forecast. The question for allocators is whether a softer labor pulse challenges existing risk budgets or earnings assumptions. What would mathematically challenge this read would be a clear reacceleration in hiring and a broadening of job growth back toward prior highs. Credit conditions are tracked through high-yield credit spreads, which the engine currently classifies with red momentum. Spreads widening, defined as risk premia rising relative to recent norms. This matters because high-yield spreads are one of the cleaner gauges of how much compensation markets demand for taking on default risk. In our framework's reading of comparable periods, this roughly coincided with more selective behavior in equity markets and periods where weaker balance sheets underperformed over the following months. Again, an observation under our methodology, not a forecast. The practical question is whether this widening in credit spreads alters comfort levels with leverage or lower quality exposure. A decisive tightening of spreads back toward cycle lows would challenge this interpretation and would be recorded by the framework as a momentum shift. For the fourth signal, the sector and commodity mix is instructive. Technology stocks are down more than 2%, while healthcare, utilities, financials, materials, real estate, and gold-linked exposures are all positive, with the broad gold fund up just over 2% and spot gold itself higher. The framework marks defensive sectors and gold with green momentum, defined as positive above-trend rate of change after a period of relative underperformance, while long-duration bonds are essentially flat. Investors watch this rotation because it speaks to how the market is distributing risk between growth and defense. In our framework's reading of comparable periods, This roughly coincided with continued differentiation between cyclical and defensive groups over the subsequent weeks, with real asset inflation hedges often holding their ground, a record of past behavior, not a forecast. The question it raises is whether positioning meaningfully leans into or away from these defensive areas. A sustained resurgence in growth-heavy sectors with fading strength in gold and defensives would challenge that read. Turning to the conditional map, the first trigger watches the 10-year Treasury yield at 4.45%. If the 10-year yield crosses 4.45% and holds for 5 consecutive sessions, in our framework's reading, an acceleration in the inflation composite appeared in roughly 9 of 11 comparable conditions. A historical characterization, not a forecast. In regime terms, such a move has tended in our sample to coincide with environments the framework classifies as moving toward expansion to acceleration, where both growth and inflation math firm at the same time. The second trigger focuses on investor psychology via the Fear and Greed Index. If fear and greed drops below 15 and holds for 5 consecutive sessions, in our framework's reading, the confirmation score deteriorated in roughly 7 of 9 comparable conditions. A historical characterization, not a forecast. In past regimes, that configuration has been recorded as a deterioration in alignment, prompting the framework to mark a regime watch flag rather than a clean, persistent state. The map is live. These conditions are being monitored daily across all 21 series. Atlas is the automated, rules-based engine inside Given Analytics. It does 2 things in parallel. First, Atlas publishes a view of the macro environment, the regime, the confirmation score, and the historical base rates we just covered, across all 21 series as a contextual snapshot. Second, Atlas runs a fixed 4-layer mathematical framework: price structure, rate of change, risk regime, and market participation across 407 symbols every trading day. When all 4 layers agree on a symbol, Atlas records it as an upside-aligned or downside-aligned condition under the framework, a reading of how the 4 layers line up, not a trade, and not advice. These are time-stamped model readings, logged for members to study as historical behavior and current math. The environment view and the condition log sit side by side inside Atlas. They are separate outputs. The regime does not pick the 407 symbols. The 4 layers do, independently of regime labels. Members use Atlas to study how the framework has recorded conditions across prior environments, as historical behavior, not as trade selection. Atlas runs the framework. Members study the outputs and environment. They decide what to do next. May, potential, and educational are the posture. The math is there for analysis, not prescription. The morning brief is the public surface. The live Atlas dashboard shows the full 21 series regime map, today's mathematical conditions across 407 symbols, and the historical archive side by side. Members study the environment and the Atlas outputs each morning, using them to frame questions about risk tolerance, patience, and exposure. If you want to track this alongside us, the live view is at givenanalytics.com.